So with a whole life insurance policy, what are the differences between the policy owner, the policy insured, and then the policy beneficiary? Let's begin with the policy owner. The policy owner is the individual that has control of the life insurance policy. If you own a whole life insurance policy, it's yours. You own it. The owner typically funds the policy, meaning you're the one making the premium and PUA payments. You have access to the cash value through loans. Loans will only be authorized upon your request, the policy owner's request, and then you also assign beneficiaries. So you may start out with a policy where your wife and kids are the beneficiary. However, as time passes, you set up a trust and you want the trust to be the beneficiary. Well, as the policy owner, you have the right to adjust the beneficiary from your wife and kids to the trust, meaning you're authorized to make those changes as time passes. Now, when it comes to policy ownership, you own the cash value, which is what everyone is attracted to. So you own the cash value. As that cash value accumulates, you've got access to it, but you can also transfer it. So with policy ownership, it can be transferred to another individual or entity. An item to be aware of: if you transfer ownership of a policy to someone other than your spouse, let's say I transfer it to a business partner, a friend, neighbor, whoever it might be, I can legally transfer ownership to them. I sign off on it, they sign off on it. However, the gains on the cash value may be taxable to the new owner as ordinary income, which I definitely want to be aware of before I make that transfer. But it is possible to transfer ownership of a policy. And also, when it comes to policy ownership, a policy can be set up where an individual owns a policy, a trust owns a policy, or it can be owned by a company, small or large. Let's progress on to number 2, which is the policy insured. This one's simple. The insured is the individual that the actual life insurance benefit is placed on, meaning when the insured dies, that's when the death benefit is paid out. It's common to see the owner and the insured be the same. For example, my first policy that I took out when I was 23 or 24 years old, I set it up where I was the owner, I paid the premium, I had access to the cash value, I assigned the beneficiaries, but I was also the insured. Meaning when I'm assigning those beneficiaries, I'm saying, when I die, they get this much money. So it's common to see the owner and insured as the same person. However, there's many times where that's not the case. Maybe a trust owns a policy. You'll see that in estate planning cases. Maybe it's a company that owns a policy. There could be a variety of reasons to do it that way. But there is a difference between the policy owner and policy insured. Main thing with the policy insured, what happens? When you die, the death benefit is paid out. And then number 3, the policy beneficiary. So the beneficiary is the individual or entity that receives the death benefit of the life insurance policy when the insured dies. Now that beneficiary receives those proceeds income tax free. So if I set a policy up where my wife is the primary beneficiary, what happens is when I die, she receives the life insurance proceeds income tax free. Now, does the beneficiary have to be an individual? No, it does not. Perhaps I set my beneficiary up to be a trust. This way, when I die, the trust receives the money income tax-free, and then the trust explains exactly how that money is paid out, who it's paid to. I can set up a trust however I want. Or perhaps a policy is set up where a company is the beneficiary. This is most common, where a company owns a policy, the insured is the owner of the company, or executives, and then the beneficiary is also the company. So to illustrate, let's say a company owns a policy on me. The company owns it, funds the policy, I'm the insured, meaning when I die, the death benefit's paid out. The company will still be around after I die, so the policy is set up where the beneficiary is who? The company. The company can be nice if they decide to do so and say, we'll give a portion of that death benefit to your family, Steve. However, we own it, we're funding it, we benefit from the cash value, but because we're funding it, When you die, because you're the insured, we're also making ourselves the beneficiary. And because they're the owner, they have control of that. So let's recap on those three. The policy owner is the individual that has control of the policy. They're typically funding the policy, premium and PUA dollars. They have access to the cash value. They benefit from the cash value growth. They assign beneficiaries. It's theirs. If you own a policy, it is yours. The insured is the individual that the life insurance benefit is on, meaning when the insured dies, the death benefit is paid out. And then the beneficiaries are the individuals that benefit from the insured's passing. What I mean when I say that is they receive the dollar amount income tax-free. So if it's a $1 million policy and the insured dies, $1 million is paid income tax-free to whoever the designated beneficiaries are. I hope this helped. Let us know if you have any follow-up questions, and we'll see you in the next video. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.